Welcome to the deep dive. Today we're looking at Kotak Mahindra Bank, or KMB. It's a huge financial conglomerate, but it's hit a really interesting, maybe tricky point.
Uh-huh. A critical inflection point, you could say.
Exactly. And our mission today, using the sources you sent over, is to figure out, is this a classic turnaround play waiting to happen, or, is the story fundamentally broken?
Well, that inflection point really stems from the regulatory earthquake back in April 2024. The Reserve Bank of India, the RBI, slapped them with a pretty severe ban.
Right, and that was because of IT governance issues, deep-seated problems, apparently.
Persistent non-compliances was the official term, yeah. And look, while that ban was lifted back in February 2025, the market still very wary.
You can see that in the numbers, can't you? I mean, the consolidated return on equity, the ROE, seems to have bottomed out. What was it, Q2 FY26?
Yeah, 10.65%, really low for them.
And the valuation, too. Price to book is hovering around 2.7. That's a 5-year low.
Right.
For a bank like KMB, it feels like the market's pricing in some serious doubt.
It definitely suggests skepticism about the asset value, yeah, but it also sets up this potentially unignorable scenario if they can pull off the recovery.
Okay, so potential opportunity. But why did they survive that initial crisis? What kept them afloat when the RBI came down so hard?
It really comes down to their structure. KMB isn't just a bank. It's built on 4 pillars. Banking and lending, yes, but also capital markets, asset management, and protection, which is insurance.
Ah, the conglomerate model.
Exactly. And the RBI ban directly hit the main banking pillar. But the real strength, what analysts often call the crown jewels, are those other capital-light subsidiaries.
Asset management and capital markets, you mean? They're big in the affluent space, right?
Dominant, especially with affluent and institutional clients. And they really acted as shock absorbers here.
But wait, relying on fee businesses like asset management, isn't that risky too? If the economy slows down, don't those fees dry up, even if they buffered this IT crisis?
That's a fair point about general cyclicality, absolutely.
Yeah.
But in this specific crisis, their resilience was, well, it was pretty immediate. Just look at the Q2 FY26 results.
Okay, what do they show?
The core bank's profit after tax, the PAT, it was down 5% year over year, directly because of the ban's impact.
Okay, makes sense.
But the asset management segment, stellar growth, up 39% year over year. That non-lending income was this crucial counter-cyclical buffer. It basically stopped the group's overall profit from just collapsing.
So the diversification worked, the moats held, but there's definitely a scar, isn't there? The ban stopped digital customer signups and credit cards.
That's right. It basically froze their high-growth digital platform, Kotak 811. Huge blow.
And the biggest impact was on their funding.
Absolutely. The main casualty was their queso ratio current account savings account. KMB was famous for having a really high, cheap queso base, around 60% peak.
And after the ban?
It just fell steadily. By Q2 FY26, it was down to 42.3%. Losing that low-cost funding, that's a major operational hit.
Okay, so losing momentum, losing cheap funding, that forces a change. Which brings us to the new CEO, Ashok Vaswani. An outsider, right? He came in January 2024.
Correct. And his strategy, what they're calling Act 3, isn't about just patching things up. It's a fundamental shift. It's pretty aggressive.
Aggressive how?
They're explicitly going on offense to rebuild the retail side, specifically the unsecured part, personal loans, credit cards, that sort of thing. The plan is to double the share of unsecured loans in their portfolio.
Double it from what, around 9% now?
Yeah, from 9.2% currently. And they want to do it fast over the next, say, 12 to 18 months. It's a big, high-stakes push to claw back market share.
Hold on. KMB's whole reputation for decades was built on being prudent, almost conservative, especially with lending. Now they want to double down on unsecured right after a massive governance failure. Isn't that risky? Combining a cultural fix with a high-growth gamble.
That is exactly the bear case. You've nailed the core tension here.
So what's the bull case then? How do they justify this?
The bulls argue the crisis was damaging, yes, but ultimately cyclical, not structural. They believe we're at the bottom, the trough. And analysts are forecasting a rebound, like a minimum consolidated CAGR of, say, 15 to 18% over the next 5 years.
15 to 18% growth. That assumes they navigate these risks perfectly.
It does. And the risks are clear. 1, was the IT governance failure truly fixed, or is it just a surface-level patch? Is the cultural problem still there?
Right, the trust deficit.
And 2, this aggressive pivot to unsecured lending. Can they execute that without compromising their famous risk management DNA, especially if the economy takes a downturn while they're mid-pivot?
So it's really not the old KMB anymore. Investing now isn't a buy and forget situation based on their history.
Not at all. It's explicitly a buy and trust. You're betting on the new CEO, Vaswani, to pull off two huge things.
Yeah.
Permanently fix the governance issues and execute this high-growth, higher-risk strategy without blowing up.
Okay, so the crisis was self-inflicted, maybe cyclical, didn't kill their best parts, but the cure might be risky too. So for you, the listener, here's the final thought. What's the bigger long-term threat here? Is it the lingering shadow of that tech and governance failure, or is it the execution risk tied to this bold, aggressive, new growth plan?